You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. It is Tuesday, 3rd February 2026, and we are looking at a market that is really attempting to find its footing.
It definitely is.
It was a week where geopolitics and monetary policy didn't just meet. They collided head on.
Right.
We're seeing this massive restructuring of global energy flows, all driven by a new trade agreement between the United States and India, just as the Reserve Bank of Australia shocks the system with a sudden return to rate hikes.
And all this is happening while markets are trying to balance a recovering U.S. manufacturing sector against, the uncertainty of a partial government shutdown and these lingering tensions in the Middle East.
It is a messy, contradictory picture, but the opportunities are hiding in the details. Let's get into it.
It's certainly a morning where headline risk is dominating the fundamental data. But I think we have to start with that structural shift.
The big one.
The big one. Because what happened between Washington and New Delhi this week isn't just a trade deal. It's a complete rewiring of the global energy map.
You're talking about the announcement from President Trump and Prime Minister Modi. They're calling it a major pivot in relations.
Mm-hmm.
Usually when we hear pivot in, diplomatic speak, it means a nice photo op, a handshake, maybe some cultural exchange. But the details here are, they're surprisingly aggressive and very specific.
Aggressive is exactly the right word. This goes straight to the heart of the global energy supply chain. The core of the agreement is pretty stark.
Okay.
Basically, Prime Minister Modi has agreed to stop buying Russian oil.
Mm-hmm.
Full stop. In exchange, India is committing to buy significantly more oil from the United States and potentially from Venezuela.
Wow. That is a massive reversal. I mean, for the last few years, India has been the primary lifeline for Russian crude.
The number one buyer, yeah.
They were buying it at a steep discount, refining it, keeping their whole economy running on it. So why would Modi agree to cut off that cheap supply? What is the United States offering that makes the math work?
Leverage. Pure and simple leverage. The United States is using its consumer market as a bargaining chip. The deal involves the U.S. cutting the reciprocal tariff on Indian goods from 25% down to 18%.
Okay, just to clarify for everyone listening, when we say reciprocal tariff, we're talking about the tit-for-tat taxes the U.S. applies to match whatever tariffs India charges on American goods. Is that right?
Precisely. It's a mechanism to level the playing field, but the sweetener's even bigger.
Bigger than that cut.
Oh, yeah. The White House is also dropping an additional 25% penalty tariff on Indian imports, and that had been specifically linked to those Russian oil purchases. So India is suddenly getting much cheaper, much cleaner access to the American consumer.
So the penalty for buying Russian oil is gone because the buying stops.
Exactly.
And on the flip side, I read that India is moving to reduce its own tariffs and non-tariff barriers against the United States to zero.
That's the quid pro quo. And there's a specific Buy American component where India commits to higher levels of U.S. purchases across the board. But if you step back, the real insight here isn't about tax rates.
What is it then?
It's about the weaponization of trade policy to achieve a geopolitical goal.
Meaning the administration is using tariffs to starve Russia of its oil revenue.
Exactly that. By redirecting Indian demand away from Russian flows and toward U.S.-linked barrels, the administration is effectively trying to sever one of Russia's last, reliable revenue streams.
Mm-hmm.
And at the same time, they're boosting U.S. energy exports.
It's a dual-purpose move.
Hurt the adversary, help the domestic industry. Exactly.
But practically speaking, this seems like a logistical nightmare. I mean, you can't just flip a switch and replace millions of barrels of Russian Urals crude with West Texas Intermediate or Venezuelan heavy. The chemistry is different. The shipping routes are totally different.
You're right. The physics of it takes time, of course. But the market signal is immediate. The market now knows that Russian oil has lost its biggest buyer. That creates a glut of Russian oil looking for a home, probably at an even steeper discount, while demand for U.S. and Venezuelan crude tightens up. It redraws the entire pricing map instantly, even if the tankers take months to actually reroute.
Speaking of pricing maps, this segues perfectly into the weirdness we're seeing in oil prices right now.
It is weird.
You'd think with all this geopolitical maneuvering, plus the tensions in the Middle East, oil would be skyrocketing. But crude is trading soft. It's down more than $3 a barrel.
It's counterintuitive, isn't it?
Evet.
This is what we call the war risk premium, unwinding in real time.
Unwinding. But, I mean, we have Israeli officials estimating that President Trump might launch an attack on Iran, and we have Iran's supreme leader warning about expanding the war regionally. That sounds like risk is increasing, not unwinding.
It does on the surface, but markets are, they're cynical mechanisms. They don't trade on morality or fear. They trade on probability.
It's okay.
Last week, the probability of an immediate war was priced in at, let's say, 80%. This week, because of one specific meeting, that probability dropped to maybe 40%.
And you're referring to the meeting in Istanbul this Friday?
Yes. United States envoy Steve Witkoff and Iranian Foreign Minister Abbas Araghchi are expected to meet. The rumor mill is buzzing about a package deal to prevent a direct conflict.
So the market just hears the word diplomacy and sells the risk premium.
Well, traders are betting that if they're talking in Istanbul, they aren't shooting in the Persian Gulf. It's the old adage, buy the rumor, sell the news. In this case, the rumor was a war, so they bought oil. The news is diplomacy, so they're selling it.
That feels like an incredibly dangerous bet. We're literally walking a tightrope here. It's a binary outcome. If that meeting in Istanbul goes well, okay, oil might stay soft. But if it falls apart,
then that risk premium comes roaring back with a vengeance. And it's not just the Middle East. Look at Eastern Europe. We have trilateral peace talks, U.S., Russia, and Ukraine set for Abu Dhabi on Wednesday and Thursday.
Which, again, sounds promising on the surface. President Trump claimed that Vladimir Putin agreed to no missiles in Kyiv.
Right. But then we saw reports of explosions in Kyiv after that claim was made.
That disconnect is what worries me. You have the diplomatic statement, no missiles, and then the reality on the ground, explosions. It makes it very hard for an investor to trust any kind of stability narrative.
And that's why volatility is still so high, even if the price itself has dipped. The market is just trading headline by headline. It's schizophrenic, really. One minute it's a diplomatic breakthrough, the next it's a policy shock. And frankly, until we see the outcome of these meetings in Istanbul and Abu Dhabi, oil is going to be incredibly twitchy.
So we've got a confused geopolitical picture. Let's bring it home to the U.S. domestic economy because, honestly, the picture here is even more baffling. I was trying to come up with a word for it. Resilient. Confusing.
I think boom and blackout is the best way to describe it.
Okay, boom and blackout. Let's start with the boom part. We got the Institute for Supply Management Manufacturing report.
And for listeners who don't watch this every month, the Institute for Supply Management report is a diffusion index. Anything above 50 means the sector is expanding. Anything below 50 means it's contracting.
And we have been below 50 contracting for a very long time.
A full year. But this week, it pushed back into expansion territory. And not just barely, it's the fastest pace of growth since 2022.
That's a huge signal. It means that despite high interest rates, despite all the tariff talk, American factories are actually making more stuff and selling more stuff.
It's a very bullish signal for the real economy.
Yeah.
It tells us there's underlying demand. Companies are restocking inventories. They're not hunkering down for a recession. They seem to be gearing up for activity.
Okay, so that's the boom. Here comes the blackout. Usually when we see manufacturing tick up, we look to the jobs report to confirm it.
Right.
We want to see if factories are hiring people to make all that stuff. But we're not getting a jobs report this Friday, are we?
No, we are not. And this is where the partial government shutdown stops being a political sideshow and starts becoming a real market risk. The Bureau of Labor Statistics is shuttered. There will be no January jobs report released. No non-farm payrolls.
And the job openings and labor turnover survey, the JOLTS data, is also postponed.
Correct. So just think about this. We have a market trying to price in a manufacturing recovery and inflation risks, and we are flying completely blind on the most important data point of the entire month. We have no idea if wages are going up. We have no idea if hiring is accelerating.
This seems incredibly dangerous for the Federal Reserve. I mean, they're supposed to be data dependent. How do they make decisions when the data is literally missing?
It forces everyone, traders and the Federal Reserve, to rely on what we call secondary signals. You have to look at things like the employment subindex in that Institute for Supply Management report, or parse through corporate earnings calls to hear what CEOs are saying about hiring, or look at private data. But that creates a lot of noise. It's like trying to fly a plane in a storm using only your backup altimeter.
And judging by the comments from Raphael Bostic over at the Federal Reserve Bank of Atlanta, they are not inclined to take any chances. He sounded pretty hawkish this week.
Bostic was very direct. He sees no rate cuts penciled in for 2026 yet. Zero.
That is a bucket of cold water for anyone hoping for relief this year.
It is. His argument is that the inflation job is not done. He explicitly mentioned that inflation from tariffs is still feeding into prices. So the Federal Reserve is looking at this boom in manufacturing and thinking, great, but if that causes prices to spike again, we have to keep rates high.
But there's a tension here. We have the manufacturing boom, but we also got the Senior Loan Officer Opinion Survey. What did that tell us?
Right. This is the under-the-hood check on the banking system.
Yeah.
And that survey showed that banks are tightening lending standards for business loans.
So while the factors are busy, the banks are basically saying it's getting harder and harder to get a loan.
Exactly. And that is a huge friction point. You can't have expanding business activity with tightening credit forever. Eventually, something has to snap. It suggests a world where the corporate economy wants to grow, the demand is there, but the supply of credit is being choked off.
Which acts as a brake on the economy over time.
Right. And that's the dilemma. If the Federal Reserve keeps rates high because they're scared of inflation, they might accidentally choke off this manufacturing recovery because credit just gets too expensive or too hard to find. Navigating that without the jobs data to guide them, well, it's going to be incredibly difficult.
While the Federal Reserve is trying to navigate through all this fog, we got a massive surprise from down under. The Reserve Bank of Australia decided to zig while everyone else is zagging.
This was a genuine shock for a lot of global observers. I mean, the narrative for the last 6 months has been global easing, Canada cut, Europe cut, the United Kingdom cut, everyone's waiting for the U.S. to cut, and then here comes Australia.
They raised the cash rate by 25 basis points to 3.85%.
The first hike in over 2 years.
Why? What is happening in Australia that is so different from Europe or Canada?
It's sticky inflation.
Mm-hmm.
The Reserve Bank of Australia stated that inflation is materially higher than they expected. Wage growth is strong, and private demand is growing very fast.
Governor Michelle Bullock used an interesting phrase. She said the pulse of inflation is too strong.
That word pulse is key. It implies it's alive, it's beating, it's accelerating. They feel they cannot allow it to get away from them. And here's the real kicker. Their forecasts now see policy remaining restrictive for longer. They're looking at a cash rate around 4.3% by December 2027.
Wait, 2027? That is a very long timeline for high rates.
It is an eternity in financial markets.
Sure.
And this highlights a theme we really need to watch, something we call monetary policy divergence.
Okay, explain that. Why does divergence matter to an investor?
Well, for a long time, the major central banks, the Federal Reserve, the European Central Bank, the Reserve Bank of Australia, they were all moving in sync. When they raised, they all raised. When they paused, they all paused. Now they're decoupling. The U.S. is holding steady. Europe is cutting because its economy is weak. And Australia is hiking because its inflation is hot.
So money is going to start moving around to chase the better yield.
Exactly. If you can get a higher, safer return in Aussie dollars because rates are going up, global capital flows there, it complicates everything. You can't just have a single global trade anymore. You have to be specific. If you're holding Aussie dollars, this is great news. If you're a borrower in Sydney, this is a nightmare.
It really disrupts that smooth landing narrative on a global scale. It suggests that the inflation fight is definitely not over, and different economies are failing that test at different rates.
Precisely. And it injects a kind of volatility into currency markets that we just haven't seen in a while.
So let's zoom out. We have trade wars, shifting energy flows. We have peace talks affecting risk premiums. We have a U.S. manufacturing boom hidden behind a data blackout. And we have central banks diverging. How did the markets actually digest this chaotic mix?
Honestly, it was a rapid-fire reaction, but surprisingly resilient in some places. Equities generally found firmer footing. Wall Street liked the manufacturing growth data. They looked at the number and said, okay, the economy isn't collapsing. Companies can still make money.
And what about Japan? I saw the Nikkei 225 hit a record intraday high.
Crossing 54,000. That is a staggering number.
What's driving that? Is it just the weak yen?
That's part of it, for sure. Japanese officials clarified that the prime minister wasn't trying to talk the currency down, which actually helped weaken the yen a little. A weaker yen helps Japanese exporters like Toyota or Sony. But it's also the global growth signal. If the U.S. is manufacturing again, well, Japan sells them the robots and the parts.
So stocks are up on growth hopes. But then you look at commodities. Gold is back above $4,800 per ounce.
That's a massive move. Gold had been in a historic slump, and now it's rebounding hard.
And copper edged higher, too. So stocks are up, which usually means risk on. But gold is up, which usually means fear. How do we synthesize this? What's the aha moment here?
The aha moment is understanding the hierarchy of what the market cares about right now. What we're seeing is a split personality market. One side of the market is looking at the growth data, like that manufacturing report, and saying the economy is strong, buy stocks. That's the foundation. But the other side of the market looks at the policy uncertainty, the tariffs, the Federal Reserve staying hawkish, the Reserve Bank of Australia hiking, and the geopolitics, and they get terrified.
So the fear drives the gold and the volatility.
Exactly. They are buying stocks for the boom and buying golds for the potential blackout or conflict. It's a hedge. They're effectively saying, I want to participate in the growth, but I do not trust the policymakers not to break something.
That is a really crucial distinction. So it's optimism about the economy, but pessimism about the management of the economy.
Perfectly put. And oil is just caught in the middle of all of it, acting as the barometer for the immediate war risk. If the talks in Istanbul go well, oil stays soft. If they fail, that risk premium rear-ends the entire market.
It really does feel like we are at a pivot point. We have the U.S. and India pivoting on trade, we have the Reserve Bank of Australia pivoting on rates, and we have the markets trying to pivot from fear back to stability.
And the glue holding it all together is incredibly fragile. It relies on diplomacy holding up in the Middle East and the U.S. economy continuing to grow, despite that lack of data visibility.
We're watching a high-stakes game of Jenga, and the pieces are being moved by central bankers and diplomats alike.
And as always, the market through price will tell us who made the right move long before the official data does.
That's the perfect place to leave it. Thanks for listening to the Financial Source Podcast. See you next time.
Appreciate you tuning in. Join us again on the Financial Source Podcast.